Okay, so welcome guys to lecture 4. I know, I've been very delayed and I lied a lot about I was gonna get it done before July 4th. But here we are, August 3rd, I'm finally doing it on lecture 4. I'm sorry I'm late, I'm sorry. I've been really busy and trying to help a lot of people, and including myself, but I've been mostly focusing on me. I'm trading. Um, so it goes with saying, the Forex market, it's a really big market, and then I know I should review because I actually don't know what I said last time, but I don't really care. Okay, I'm just gonna wing it. But, I still have PowerPoint slides, so they'll help me out as I go along. Okay, so just a quote. I would start with a quote every lecture. It's like, some people say Forex is trading is dangerous. I say investing without any lack of knowledge is dangerous. So, like, if you're trading gold, for example, like I was shorting gold today, right? I was catching these pips all the way down, and like we reached the bottom, and I would have gone liquidated if I got up. So this is my funding talent account. I was scalping gold sales all the way down. I mean, I only had one lost out of many trades. I probably have to count, but I'm not gonna count. It's too much for me. But yeah, so if you don't have the knowledge of trading something and you're just going in blindly, you should stop and experiment and do it on paper. However many long you do, but you just really need to do it because there's no other way. Okay. So last lecture, I just want to go over what we did. So we did order types and margin and leverage. So we did a difference between 100 and a 500 leverage account. So since I'm just going to review real quick what's difference between a $100 and $500 account. So this funding talent, this is a real account that I am trying to do and get funded. So you have to like get more pip size. Like let's say you're doing US 30. So you really need to figure out the size. So a 0.10 lot is the same thing as on Hugo's Way as 0.01. It just takes a lot of pips because it's actually following these micro pip rules. Every pip is like 10 cents or a penny. Actually, it's a penny. I don't even want a penny. So a mini is like 10 cents, and the standard is 1 lot. So that's what and so when you do this on Hugo's Way, it doesn't. When you do like 1 lot, you're actually really leveraged. You actually use the whole account. So I'm not going to take a trade here, but I do have one on Hugo's, but I'm not going to pull that one out today. So a 0.10 lot, you're risking about $1,000 of your account on US 30 almost, but it's actually kind of leveraged, so you still can do that. This is $25,000, so we're not going to be doing anything except I missed gold dip buy. I was thinking about that, but I was like, I'm not going to try overtrade. Especially we're actually in Tokyo session, so I think we talked about time zones on the other day, and then we calculate how do we calculate profits, basically, like the number of pips. There's a lot of pips math, and when I do this, I actually do not like to do pip math. That's why I use a calculator, and we went over how to set up account, like a demo account. It depends on what broker you use. I have an approved list of brokers that I use, that I actually have used from experience. Hugo's Way is like number 1 for me, because I'm so used to it. I've been using it for like at least a year since I heard about it, and it's pretty fair and easy to understand. Like the size matters in that. But yeah, so this is like my notes that really would help. So in Hugo's Way, I really have to translate this. So a 0.1 is 1 ether, and then I have to use like 1 lot for 1 ether. So this is 100 $500 leverage account. This is a $500 leverage account. This is like if you're trading indices. Of course, it's different when you're trading currencies. They're about the same, so there's no difference between them. I just don't want to trade currencies right now. I just want to grow as fast as I can in a matter of 2 weeks, because I really need to finish this in 2 weeks. The funding talent account, I've been really focused on that lately. So I don't have time to do options or anything. It's like strictly I really need to reach my goal within 30 days. It's not enough time. It's enough time, but time's ticking, because like if I need to reach my goal of at least 1,000 in a week or two, and then I can move on to the next phase. It's like getting to 2,000, and then we can actually go more. Okay, so my goal today is that I didn't really make a point about oil and the CAD pairs. Okay, so we're going to talk about that. So order flow, order flow is something that you have to kind of like look into central banking, and you have to like know about the bonds, because what determines a currency pair and the rate it's trading at, it's actually market forces, but also it's Federal Reserve policies that are taking place. And I still forgot to share this in our group. Sorry. Okay, so okay, we're gonna do a really brief review of bonds. Kind of like I wrote this a few months ago, but it's still kind of like relevant. Okay, so policies, case studies that we're gonna do is Bank of Japan, European Central Bank, and the Central Reserve. The gold and dollar system. Okay, so brief overview. If the dollar dies, then gold goes up, basically. And then we have more correlations with currency pairs, which I try to get into. Obviously, I cannot get to all of them, but we did talk about a lot of them in the previous lectures. Okay, so this is crude oil. Okay, so anytime crude oil goes up, we have the CAD pairs going down. And this is a really true relationship. Okay, there's an inverse relationship of CAD for all the CAD pairs. So USD CAD's really affected by the dollar and crude. So anytime crude has a major melt up, then you see like US CAD will go down. So that's a really fundamental relationship. It actually happens on the pound CAD as well. So you see some relationship between both pairs. So the rule of thumb that I learned from this guy from Trader Nick and other people I learned from is that if you're just touching one pair, like it's a CAD pair, then like you're just touching the other pairs that are affected by this. So it's always good to like just not trade the same pair if you're trying to diversify your position sizes. Like you can trade gold and then US CAD, but like if you're trading the pound CAD and then US CAD, they're actually the same chart basically. Sometimes they can be the same, but they're affected by the policies and the news around their economies, and that's what we went over. I think we went over that. I'm not sure, but I'll go over it anyways. Okay, so basic understanding of bonds. Okay, this will really help you on money flow. I always point this out every time, and I always make the correlation is like you need to watch the 10-year wheel. It gives you a sense of direction with the market and the dollar. The dollar drops, the 10-year goes up, and then I always prefer to watch these two pairs. The US Swiss, because it's like basically the Swiss is like a safe haven. It used to be, but I mean Swiss banks don't give you interest anymore. And the euro dollar. The euro dollar is a really important dollar because it is the shadow part of the shadow banking system, and I talk about this in our lecture. I try to go over it, but I really want you to dig into this. It's like I cannot explain almost everything, but like there's a lot of people on YouTube that you can learn from. So people I watch for bond market news, I really am a big watcher of Steve Ballmer. I watch him like every week. I watch him while I'm running and doing push-ups, or I'm like sit-ups, or doing weight training. George Gammon is pretty entertainable. And then sometimes, if you want a Fed insider who was part of the Fed when the financial crisis happened, Daniel Booth is like the one of the people that you want to watch. Okay, so let's go over headlines around the world. Okay, so this is back a couple months ago, that when we had a Fed meeting, Jerome Powell said they would start buying a lot of treasuries and billions of dollars of treasuries every month. And then now we're at $1 trillion of treasuries. Like, I think a month ago we're at 900 billion. So there's central banks around the world, I know, have really a strong effect in the currency market and in the stock market as well. So that's one thing you have to take care of. So if they ever start talking about taper tantrums, just say, well, that's just trash. It's trash news because they can't do it. And if you kind of go into the whole bond market series and like go into like the rabbit hole, then you start understanding like world economy and how fucked up it is. There's no other way I can say it. Okay, so next up is the Bank of Japan. Okay, so usually the Bank of Japan's policy on yield control is to they artificially suppress interest rates. They have the most negative yield-bearing bonds in the world, and most of the people there in Japan, this is one of the reasons they don't use credit cards. Like, credit cards do not exist in that much usage in Japan. Everyone uses cash because they know that if you ever take a loan or a credit card out, you are actually not in a really good position, because you are, you're borrowing money, and you, or if you put money in the bank, right, you're actually losing money by paying the bank's interest, where the bank's supposed to pay you interest. That doesn't really make sense. But if you are borrowing money, that's sweet, because then like you're actually getting paid to borrow. So that's how negative interest rates work. That's something that no one ever wants in this world. We cannot have, in the United States, if we ever want negative, I don't know if that's possible or not, but if they actually do the digital currency, it's so bad. Because one of the things that they can do is watch how you spend your money. B, you have an account with the Fed. That means they can watch you 24/7, and they can freeze your account anytime. And there's so many things I don't like about what we're doing with the digital currency, but that is the future, because they want to deposit more money in this account and then give it to the people, so that way they can increase money velocity. We talk a lot about money velocity in the bond market, because you cannot have a working economy without money moving around, and that is money velocity. If money velocity is down, so if money velocity does not move up, that means like, okay, the economy is not really doing well. And that is the case. And you can look this up on the Fed's website, and you can say like, well, money has not been moving anywhere. It's just been stuck in people's accounts. And that's why you see like people saving more. Okay, so here's the Bank of Japan, Bank of China. So, okay, so this is recent, okay? The Bank of Japan cut lending rates to inject liquidity into pandemic economy last year, on top of asking banks to increase loans, okay? That help, spur growth in the economy, but it's also kind of like did property bubbles. It's the same thing we're having right now. A lot of inflation. We see it now in the summer, or oil, gas prices, and everything. and it just has an effect on the real economy that that you're gonna see a lot of deflation in down the line, because if you have things increasing up, like consumer prices index going up, and then it's, I think it's at 6 or 5%, I don't know, I probably can look it up later, but if it increases so much to the point where people cannot buy anything, like let's say you cannot buy like a piece of pork from the grocery store. Let's say, like, okay, last year's pork prices, you bought bacon for only $5.99, but now it's like increased so much to at least $8.99. I mean, that is a $3 difference. That's really expensive for bacon. Okay, so by doing this, by they expand credit policies and hiking rates, I mean that's trying to spur money growth and expansion, but at the same time, you have to just see if the Chinese economy is moving. Because if China moves the world, China does move the world in terms of exports. Because if they do not export anything, then there's a problem with the economy. Because that means, like, if we have a problem right now. Before, like, the equilibrium of imports and exports was balanced, and now to the point where we don't have any shipping containers, and this is what's happening right now. So there's a lot of things that affect in a healthy global economy, but sometimes you can always look at it from a macro perspective in terms of money flow. So where does money go? And that's what you want to be tracking. Is like, okay, so I know if this will happen based on economic events. Okay, so that's what I'm saying. Like, we can find economic events. There's Forex Factory. There's also investing.com, but we can go to Forex Factory and then we can browse through. Okay, so this is like a few months ago, but you can actually see, like, okay, you have private loans, retail sales, cash rate, these other currencies that are affected by what they're doing. So there's M3 money supply. I mean, I have not seen that before, but we can take a look later. Okay, so this is today's, and this is tomorrow's report. So the red ones are pretty important. The yellow ones are like, nah. The orange ones are like, maybe that's important. That's really important for oil, though, so we'll see. If there's a drawdown in crude oil, right, so that means, like, they're taking oil out of inventory. I mean, that is trying to keep up with this demand, and then we did do that. So we can actually expand these, and then we can look, okay, on oil reserves. So we did pull some out last week. So there's no drawdowns lately. If there's ever a drawdown, that means, like, okay, it's actually moving out of the inventory in Oklahoma. There's actually this storage facility where they store all the oil, and that's where crude oil is being stored in these big container thingies. So they're like, I think they're like giant water towers or something, but for oil. So the way we read this is, like, if there's a drawdown, I mean, if they draw up, then you might see a reaction in oil. So we'll see about next week actually on Thursday, what happens to oil. There's usually a really large reaction when it comes to oil inventories, just for oil. But okay, so we have non-farm payroll. That really affects the market a lot, and the dollar. So if we have non-farm payroll that's really bad, I think last week we pumped when non-farm payroll was really bad, and they just like, fuck it, we're gonna pump the dollar, and then the dollar just got pumped, and I think the market continued pumping. That didn't really make any sense, though. We'll see. I mean, anytime they try to pump the dollar, it just gets shorted again. You can actually look this up on Hedgepedia. Yeah, so this is all the data that's going on. So we have today, Bowman spoke today. AIG Construction Index. This is the New Zealand dollar. Okay, so that's really important for the New Zealand dollar. If we look at the New Zealand dollar for a bit, so let's just do one random one. We're just gonna do NESI Japan, and then we're just gonna see what happened to it. So looks like the report was really good because that, that spike right there, just what happened on really important news. So this is for today for unemployment rate for the New Zealand dollar, and that was really good news for the New Zealand dollar because it looks like. So let's go back to Forex Factory, and then we'll check out what is the unemployment rate. Okay, so the unemployment rate was actually pretty good. That really affected the New Zealand dollar, causing it to spike up. So that's what you see. So that was pretty good news for a New Zealand dollar, and that actually caused like one of the New Zealand pairs to, like this one right here, to have a really nice big rally to the upside. Okay, so I just like one bit on we're still going on economic news. So there's the Consumer's Confidence Report, the unemployment claims, the CPI index, which is the consumer price index, manufacturing data, crude oil, and we did look at a few, but we're just going to go one in depth, so you can all look these up later. Okay, so consumer price index, consumer confidence data. Okay, I really say this in our economy, in the United States, because we are a service economy. Consumer spending is a key driver of the economy. In the United States, 70% of GDP is consumer spending. Okay, international investors pay a close attention to the service because they serve as a great leading indicator for the overall economy. When consumers are confident about their futures, they tend to save more. No. When they are confident about the future, they tend to spend and drive economic growth. When they're not confident, they tend to save, and that's really important. We're not really confident. People right now are not confident about the consumer data report. So we actually can look at this. Okay, so let's look up some news. And then this is pretty recent. This is like 2 months ago, but it still applies to right now. So the pound dollar, okay, actually this is the pound. This actually applies to the US dollar as well. Okay, so pound steady footing ahead of the weekend of the Bank of England. Okay, higher interest rates might be required soon. Okay, this is the taper tantrum that they always do. They can't do it. It's the same thing around the world that they try to do, where like, okay, we're gonna raise interest rates, but it never happens. Okay, so head of this Gerder, I don't know how to pronounce his name, but let's say GV, this guy, initial his name, he sits on the Bank of England monetary policy, and then if rates rise occurs 2016, they have to start doing something about it, because that means like, okay, inflation's too hot, it's running too rampant. Are we in a position like in the 80s where Paul Volcker rose interest rates to I think 17%? Yeah, but at that time we were in the good place in the United States. We were still on the, I think we were still under the gold standard, something like that. I need to check. I think it was 1971 we got off the gold standard because inflation was really running hard and we had to control it. I think Paul Volcker did that rule and rose interest rates in the 80s. I need to verify that. Okay, so yeah, somewhere in the Reagan years, 1979, yeah, so we see this one, the pound dollar. Okay, should look at the pound dollar right now. Where is it at? So pound dollar, pound. Okay. So we had I'm just need to look at my template. Okay. So the meeting actually took in June. Okay, this is June. I'm just trying to find the right template. Fuck it. Alright. Well, okay. Meeting happened in June. I think it's like right here, and this is like the result. We're having the we had a lot of selling on the pound dollar. After that, it was topping out, so it kind of makes sense that that catalyst where they're tapering, they said the taper caused the pound dollar to sell off. Okay, well, that's about it for that news. Okay, so we talked about the consumer confidence index data. So it's a leading indicator, policy effectiveness, consumer, yeah. And then also because, you know, this actually kind of reacts with the retail sector, because where do you buy your shit? You buy your shit on Amazon or some other store. I mean, where are you going to get your clothes, your food, your hardwood stuff, your nice power tools, and electronic goods? I mean, this is like the confidence data that you want to look at if you are trying to gauge, okay, if the economy is going to be affected. I mean, there's times like this consumer price index, consumer confidence data is important. I think this one is like once a month, but I have to check. Okay, so actually this is kind of important. There's like, I found this really good website that actually tells you like the trend and correlations. Okay, so compare the charts. See, so this thing tells you like how correlated you are. So if you're trading like the pound dollar, these are more correlated with each other, so they will move together than US CAD basically. So if you look on this chart, you know, if you're trading a euro dollar, same thing, you have more correlations with the pound US dollar. And then if we go to, these are all the major pairs. So if you go to the US dollar Swiss, we see that, okay, the dollar and CAD are actually more correlated than these other pairs. So these are just correlations on a -1 to 1 scale. So just like what I was talking about, like you can earlier, if you trade one pair, it's more advisable you just look at what you're trading, so you don't trade the same thing that's kind of reacting to each other. So that way you have like more diversity in your positions. I don't say portfolio, because then I really don't like to keep my position more than like a couple days on currency pairs. You really know what news will come out, and like I scalp a lot, so that's why I've been scalping US 30 on 0.10. Well, I have to go bigger to like 0.50, so that's 0.05 in Hugos. But yeah, you can check these out, and then I'll paste the link to the PowerPoint and the lecture. And this is what I said: when the Fed says they want to tamper, then it's not going to happen. Someone has to play good cop and bad cop at the two camps at the Fed. There's the Lex Luthor, Karashi, and Bullard, who are on different camps. So those two different camps, you know, they are saying taper, tantrum, and everyone's like, no, we're going to keep rates low. So those are the good cops and bad cops. They're just fucking you over on your positions in Forex. They're also fucking you over in stocks. So whatever they say, and the most advisable thing is to wait and buy the dip, because the end goal of the Federal Reserve's game plan is to inflate. So they're going to keep suppressing the dollar, and they're gonna try to push the dollar as low as can, even though Janet Yellen does not like that. But she has to go what the Fed tells her sometimes. Okay, so this is today's trade. Okay, so this is what happened on the dollar. I just want to mention this. So the dollar this morning, we actually got really bad, some kind of news this morning at 6 o'clock Pacific time. Add the number of hours you are in. I'm in the west coast of the United States. Okay, so this is what happened. So the dollar spiked up. What happened in the market? You had all the indices just die before a market opened at 5. I actually saw that, and I regretfully did not get into a small sell position, but I am going to try waking up at 5 and seeing, oh, looks like we might die today. I'm going to try on a really small lot. I'm really going to try because I really need it. Anyways, as we're going along, we're just exploring what happened. So this what happened. Okay, the dollar, when the dollar got stronger and the British pound just died. It had a moment where it climbed up and it was retesting a certain level and then died a little bit. So you kind of see like activities, you know, these are actually the sessions that I talked about in the previous lecture. Certain pairs react more in a certain session. So especially when you have an overlay between London and New York, that is the most volume you can get. At the same time, if you are on New York session, you actually see more volume on U.S. pairs. So, like, since this is the U.S. dollar, you actually see at 6 o'clock or 5 o'clock, there's a lot of volume right here. So that's like always good because then you need volume if you're making a trade and you're trying to be quick to scalp. So this is the dollar franc. See how the reversal, you know, it's the inverse, died before market open and then just rallied after. So these are two pairs that are opposite each other. They don't go each other. They don't like each other. Whatever they want to do. But like, this is the pair that rallies when the dollar rallies. It's actually the opposite for euro dollar, I think. Okay, so gold and silver. Okay, so brief lecture on gold and silver. I know everyone knows what this is. So quick correlation. If gold, I think I said it multiple times. I can say it again. If the dollar dies, gold rallies. If the dollar dies, if the dollar dies, gold rally. If the dollar goes up, gold sells off. Okay, so safe haven for many people, but it is absolutely manipulated by the banks and government. And who is the government that manipulates this? It is the Federal Reserve, because they have their hand into it. Because they did not want gold at possibly 3,000. They will let it happen when it happens, and that is on their watch. If they lost control of gold last year. They might lose control of gold in sometime in the future again, because they don't have the same amount of gold that they say they have in the vaults of Fort Knox or something. But something you should kind of understand is the gold to silver ratio. You can actually look this up. Okay, so when gold trades at $500 an ounce, silver's at $5, so people kind of refer it to 100 to 1. Similarly, when gold 1,000 per ounce and silver is trading at 20, it's 50 to 1. Today, the floats are widely swing between 1. So this is the case because it's driven by market forces, not always the case, and it's set different price, different places by government seeking monetary stability. Okay, so gold, silver, government has their hand into it. Okay, so this is the gold to silver ratio. You can see like how correlated it is. So 40 is the lowest, so you can buy gold there. Right now it's going higher. So pretty much, I think it's saying gold and silver are pretty cheap. Okay, so the Fed and gold. Okay, so last week, Jay Powell said they don't want to taper tantrum. So remember I talked about two camps. Jerome Powell said no. So this means like they continue to pump the market. They continue to buy more assets. So what will happen? The market, the real estate market, the stock market, and every single market that you can think of goes up. And more money is going to be printed without anywhere to go. And that's where the reverse repo will come in, because that is the biggest thing that's going on. That's an epic bubble waiting to something to happen. And if they ever talk about easing, or no, not easing, tightening, then the repo market's going to die, and then we have a 10 to 25% correction in the market. Okay, so it take a very long time for the Fed to do that. But yeah, so gold can actually be 3,000. I don't know when. But I think maybe in the 5 years that we might have with Jay Powell. Okay, so that's about it for my lecture today. And I didn't really put a summary slide, but I think the next lecture, I don't know what I'm going to talk about, but I'll figure it out. I have to look back on my notes. Alright, so I want to thank you all for listening to this lecture, and I will get, if you're in Chef's group, I mean, I'm doing this obviously for free. And I want you guys, if you're tired of trading stocks, you're tired of losing money in stocks, and then your options expire, worthless, and all these other bullshit, then yeah, maybe Forex is for you, because you can actually control how much you're spending, because then I can give you an example right now. Let me just open up Hugo's Way. Damn it, they're all sleeping. Okay, so you kind of see like free margin. That's how much you're using. And margin level, actually, free margin. Okay, so right here, this is how much margin I'm actually using. Okay, so margin is the amount of you're using, and the amount of free margin, that is like free cash right there that you're able to use. So I'm only using about $758 $19 of margin, which is pretty much how the amount of risk I'm doing for the potential gain of, I don't know, maybe $200. That's how much I use. So this is what it's trying to explain. So free margin, if you deduct this from that, that's how much money you have. So that's a question someone asked me, and I mean, this actually took me until about a week ago that I figured out what it all means about this, because no one actually explained to me what does all mean, and I should put that one day on the slide what this means. But yeah, that's what it means. But yeah, Forex is like a different type of market. There's a different way of thinking. You can lose a lot if you don't have a stop loss, so you shouldn't be stupid and not do stop losses. So this one I don't really care, because I'm running an experiment on Bitcoin. The trend for me for Bitcoin is like it's gonna go down. For a quick retracement, that's what I'm looking for, and I'm okay with it. So we'll see in the next 4 hours for Bitcoin. Okay, so that's about it. I know it's late and everyone's kind of sleeping. So we'll end the stream here, and then we'll talk later, basically. Alright, see you guys.